We don't just build wealth, we build legacy. Welcome to the Retirement Income for Life show with Doug Vincent. For over 30 years, Doug has helped families right here in the DC area turn hard work into lasting income, helping you protect what you've earned, provide for your family, and retire on your terms. This is where preparation meets opportunity. This is the Retirement Income for Life show. Here's Doug Vincent.
Today's 60-40 portfolio. On today's show, we're going to focus in on rethinking the role of bonds, as well as fixed index annuities in a modern retirement income plan. Welcome to the show. This is Doug Vincent. I hope this program is finding you well. And we just want to, as always, give a shout out to those in the Maryland, DC, Virginia area, the DMV. Shout out to all our listeners, and thank you for all your messages and responses. And we've been doing a number of consultations with those in the DMV area and around the country to help make sure you are positioned for retirement income for life. See some of our old episodes on our podcast, our YouTube channel, Retirement Income, the number 4, life.com. You can always reach us by phone at 301-242-3950. And, don't forget our website, which is Retirement Income, the number 4, life.com. So today we want to focus in on the, as we had mentioned, a traditional 60-40 portfolio, and talking about bonds, talking about fixed index annuities, other things, mutual funds, things of that nature. So is the traditional 60-40 portfolio still something that is right in today's retirement environment? We're going to revisit one of investing's most popular strategies, and we want to explain why diversification, not a specific percentage, is the real key to your long-term success in the markets today. So we definitely want to break down some of the old, some of the new, and just revisit that topic. Also, number 2, bonds aren't as safe as many investors think. Bonds aren't as safe as many investors might think. We're going to discuss today's higher interest rates, right, and the risk that many retirees are overlooking right now, because I'm talking to them weekly. And so we want to make sure we have a conversation about bonds and, why they should be in your portfolio, why they shouldn't, things of that nature. We'll break down that today. Also, could a fixed index annuity fill part of the gap in your retirement income plan? Ask yourself that question. Could a fixed index annuity, as an overall diversified financial plan, could that be a part of filling the gap? And we're going to explain how that works today, how they might be appropriate for you, how they might not be, but they help create. One thing people don't realize a lot is that fixed index annuities help create protected growth and give you potential guaranteed lifetime income if they are structured properly. And, just a number of features there with fixed index annuities. We'll talk about that as well. And then we'll wrap up today hoping that you recognize that there's no perfect retirement investment. There is no perfect retirement investment. Okay. We'll wrap up discussing why the best retirement plans combine different tools for different purposes. Right. And why understanding the trade-offs is just as important as choosing the investments themselves. Okay. So we got a lot of good nuggets for you this week and a lot of wisdom. And as we always give you a little nugget of wisdom. And believe it or not, today's financial wisdom is coming from old Abe Lincoln. All right. And so Abraham Lincoln said, in the end, it's not the years in your life that count. It's the life in your years. Go ahead, Abe. Let me say that again. And in the end, it's not the years in your life that count. It's the life in your years. And so every day, that's what we are hoping that we are able to do for all of the clients that we work with. Anybody coming into my office, I want you to be able to celebrate a retirement plan that can last another 2-3 decades. You've fully built it out. You've fully been consulted properly. And we hope, you know, that you got a lot of life in your years once you walk away from the job. All right. So number one, what is the 60/40 portfolio, and is it still a good idea? Okay. What is a 60/40 portfolio, and is it still a good idea? So for generations, many investors have treated the 60/40 portfolio as retirement, as like it's retirement planning shorthand. Okay. And you'll put roughly, 60% goes into stocks. That's your growth. 40% goes into your bonds for, the stability and the income. These things get rebalanced periodically. And, you just let diversification do its job, right? This idea came from diversification principles. This is behind what we call modern portfolio theory. And it's not one universal formula, but Mr. Harry Markowitz showed why combined assets with different risk and return characteristics can improve a portfolio, right? That's the familiar 60/40 split that has traditionally been in place. This is basically a practical interpretation of that. So bonds can still play an important role, but bond and safe are not interchangeable. Okay, so what do I mean by that? Everybody, has felt over the years, you say the word bond and we automatically assume that means safe. So with this environment that we're in with rising interest rates, this can push your existing bonds lower. Those bond prices are going to go lower as interest rates go up. So inflation can weaken that real income. Okay, you have credit risk related to bonds, reinvestment risk, and the timing of withdrawals can also affect, how the retirement incomes play out if you don't understand how bonds affect your portfolio. Okay, so for today's retirees, we're trying to help them solve, for more than just portfolio growth, right? Most retirees are needing today more liquidity, right? More protection from market losses, income that they can count on, right? And enough long-term growth, we want to make sure we have enough long-term growth to support a retirement, as I continue to say, and as I continue to see, for 2 decades or 3 decades, sometime even 4. Okay, so this has to, income has to remain, the risk has to be, your portfolio has to be diversified enough to protect against the risk. And so on today's show, we're asking a bigger question. Okay, should part of the traditional bond allocation be evaluated for a fixed index annuity? So that 40% that normally would be allocated to bonds, in the practical theory of it's only bonds. Okay, in today's environment, should a fixed index annuity, right, be the substitute for traditionally where there are bonds, right? Fixed index annuities can protect principal and from, they protect principal from direct market losses. And when selected for that purpose, we also have riders and different features and benefits to provide guaranteed, lifetime income. This lifetime income stream, no matter what the market does, can make sure you have that guaranteed lifetime income, right? So we're not declaring bonds dead, okay? And we're not prescribing the same 60/40 split for everybody, okay? We're just doing a reexamination, okay? And that 40% portion is supposed to accomplish, different things for retirees, right? It is the current mix, of what you want your goals to achieve, right? Is the current mix, is it built for that lifetime funding? Is your current portfolio, the way it's structured, built to fulfill that dream retirement that you have, right? So the 60/40 portfolio, it's earned a reputation of, for the diversification, breakthroughs in diversification. It's not a magic percentage. It's earned that reputation for decades, right? You've been hearing about this for years. And so you probably heard that a 60/40 portfolio is the gold standard for investments, right? Once again, 60% in stocks, 40% in bonds, right? And there's a reason that approach became so popular. It was built on a sound investment principle that has stood the test of time. Okay, we touched on that a little earlier, but here's the important question, right? And this is the real lesson from the 60-40 split itself, right? Is, what's the idea behind it? You ask yourself the question, what was the idea behind that, right? And does it apply today? Okay, today we want to look at why diversification became such a breakthrough and why the traditional allocation worked for so many years, and why retirement may call for a different approach as you are planning to retire here in 2026. Okay. So one of the biggest, things related to this, and one of the biggest breakthroughs related to investing, when we're talking about investing, this came from this economist we had mentioned, Harry Markowitz. Okay. And his portfolio theory was called modern portfolio theory, right? And his research showed that investors shouldn't evaluate investments one at a time. They should consider how different investments behave together as part of an overall portfolio. The idea was that combining assets that don't always move in the same direction could help reduce overall portfolio volatility. Diversification can't prevent losses or guarantee profits, but it can help smooth the ride compared to putting all your eggs in one basket. One thing that's often overlooked, and that Markowitz, never said every investor should do this, right? Exactly 60, exactly, 40, 60 stocks, 40 bonds forever. His work was about building portfolios, simply taking a unique approach around different individuals, building a portfolio for the separate goals and risks that you might have. It's not a prescribed one permanent formula. It was just providing a basis to then dig into who you really are. Okay. And so the traditional 60-40 allocation gained popularity because it struck a practical balance between growth and stability. Stocks were expected to provide long-term appreciation and help investors keep pace with inflation, while bonds generated income and often held up better during stock market downturns. Another key part of the strategy was the rebalancing. When one asset class significantly outperformed the other, investors would periodically sell some of the winners, right, and buy more of that which was lagging, basically buying the investments on sale to restore the original allocation, right? This process, it naturally encouraged buying low and selling high over a long period of time. So for many investors, right, the simple framework worked well across a variety of environments, and it provided a disciplined approach without requiring constant market prediction. So you weren't sitting there having to time the market, over and over, which has not traditionally been a success. So a younger investor may have decades to recover from a market downturn. Retirement introduces an entirely different challenge. Okay, you don't have as much time. Once you're taking withdrawals from your portfolio, market declines can have a much greater impact because you're selling investments while they're temporarily down. Okay, so that's what's known, as we've mentioned on previous episodes, previous shows, that's what's called sequence of returns risk. Okay, even if long-term average returns look fine on paper, poor market performance during the first several years of retirement can significantly affect how long your money is going to last. And this is why retirement planning often becomes less about chasing the highest return and more about creating that dependable income. As you maintain adequate liquidity, okay, and, unexpected expenses show up, and you are also managing taxes, efficiently, we're making sure that your portfolio can support a retirement for as we've mentioned, 25, 30 years. Okay. So the enduring lesson that we can take away, from the modern portfolio theory, the 60-40 allocations, take this away. It isn't that every investor should follow this one specific allocation, right? The real takeaway is that every investment should have a clearly defined purpose within your overall financial plan. Your financial plan is unique to you. Okay, that's why the consultations are so important. That's why your written document is so important. And some assets are there to provide long-term growth. Others generate income. Some help preserve principal or provide liquidity when markets become volatile. Once you understand the role each investment plays, your portfolio becomes much more intentional. Okay, a portfolio that's appropriate at age 40. Okay, while you're accumulating assets, may not be the right fit at age 65 in retirement. It's now an asset preservation strategy, right? Or distribution strategy. Your investments should evolve as your goals, income needs, and retirement timelines change. Okay, so let's look at this with some statistics by the numbers. In 1990, Mr. Markowitz received a Nobel Prize in economic sciences. This was groundbreaking work, and 15.3% approximately how much a traditional 60-40 portfolio declined during 2022 was about 15.3%. And when both stocks and bonds experienced these unusually difficult years, that's, over that time frame, that's what you saw. Now, in 2025, the approximate return, on that 60-40 balance was 16%. Okay, so if you look at that time frame, instead of asking, as we've said before, whether your 60-40 portfolio, ask what job each investment is performing. Okay, it's not just 60-40, 60 in stocks, 40 in bonds. Ask what jobs are they performing? What are the investments doing, right? Every dollar in your portfolio should have a purpose. If in 2022, if it was down 15.3, but then, in 2025, it's up 16%. If you had that balance every other year, you're not really going to be too happy with that rate of return. It's not that drastic historically, but just keep in mind how unique your plan needs to be, and it needs to be managed and audited, and making sure that you're looking at the different market cycles and, looking at different investments other than just bonds. And so these results, from one market cycle to the other, can really vary. Okay. So instead of asking whether your portfolio is 60-40, ask which job each investment is performing. Every dollar in your portfolio should have a purpose, whether that's generating income. You might have that as your number one purpose, as you go into a retirement. What about protecting principal? You don't need this money immediately, but you're going to need it down the road, right? So what about providing growth or creating flexibility? A percentage in your portfolio, listen carefully, a percentage of your assets in your portfolio without a purpose is that's just a habit. You got into a habit of as you are even on your job now, of accumulating assets by way of, every time you get paid, you contribute to your 401k, you see the match, that's a habit. Okay. Once we get closer to retirement, we need to change that habit into more purposeful direction and diversity that can take place to make sure that happens. And so the 60-40 portfolio earned its reputation because it was built on the concept that we've talked about, diversification, right? But the allocation itself was never meant to be a one-size-fits-all solution, right? So as we summarize this, let me say that again. The 60-40 portfolio, it earned its reputation because it was built on this concept of diversification. But the allocation itself was never meant to be a one-size-fits-all solution. So what am I saying? As your life changes, right? And especially now that you're retiring this year, you're 1 year out, you're 3 years out, right? Your investment strategy should reflect your current goals. Okay. You got to update this annually. You got to update this definitely as you're preparing to retire, your strategies need to reflect current goals, income needs, risk tolerance, not just a formula of the 60/40, allocation, right? So think about this. Ask yourself this question. Has your portfolio been running on the same allocations for years? Okay. You haven't had a second look. You haven't dived into it. And this is something that we're doing weekly. And we'd be happy to help you evaluate whether your investments are still aligned with your retirement goals. This is why we're scheduling 100% free consultations right at our website, retirement income, the number 4, life.com. You can call us at 301-242-3950. We are here to help making sure that you put these plans in place and you evaluate your diversification so that it is specifically unique to you. All right. So let's talk about bonds. A lot of people think bonds can't lose money. Bonds aren't risky. Are they safe? Are they not safe? And for generations, many investors have viewed bonds as the safe part of the portfolio. Okay. And this is compared to stocks, of course. So bonds generally, yes, are less volatile. Yep. Less risky doesn't mean risk free, though. Okay. So less volatile, less riskier than stocks. Yeah, I would agree with that. But it doesn't mean risk free. And so today, let's talk about why bond values can still go down. And, that is a misunderstanding that a lot of people have, that bonds are, fixed and never could go down. And so today's higher interest rates that we're experiencing, can actually create some new opportunities to diversify yourself, out of maybe some bonds that are losing money. That's possible. And, let's talk about how to think about bonds as a part of an overall retirement income strategy to complement Social Security or complement your pension, those other sources of income that you already have coming in. So bond investors, have something they haven't seen in quite a while today. Okay. And recently, if you examine the 30-year Treasury, it's above 5%. And that's one of the highest levels that we've seen in the last 2 decades. And, that's welcome news for retirees and income-focused investors, because newly issued bonds are paying significantly more than they were just a few years ago. You see why this evaluation needs to take place, It's important to remember that not every bond pays the same yield. Okay, so you have to examine the different types of bonds that fit, your goals and aspirations now that you're moving into retirement. Interest rates vary depending on whether you're buying treasury bonds, municipal bonds, corporate bonds. Different factors also connected to those are the maturity dates. Okay. And there's also something called credit quality. Okay. And so for investors purchasing individual bonds and planning to hold them until maturity, today's higher yields can provide a much stronger income stream than what was available during the ultra low interest rate environments. Rates have been low for, many, many years. And as we've said, we've seen levels now, that are higher than we've seen in the last couple of decades. Now, one of the biggest misconceptions is that bonds never lose money. Okay. Is that you today, that you have been told that, or you think that? Right. In reality, when interest rates rise, the market value of existing bonds generally falls. Right. And this is because investors can purchase these new bonds that are issued at higher rates. So if I can get a higher rate on a new bond versus the old bond, I want that. Right. And it doesn't necessarily matter if you own an individual bond and hold it until maturity. Okay. Assuming the issuer doesn't default, you typically receive your face value back at the end of the term. But if you need to sell bond, before maturity, you may have to accept a lower price than you originally paid. Okay. And so, there's some strategy that has to go into buying and selling and holding. And so longer term bonds tend to be much more sensitive to interest rate changes, right? So and the longer you hold it, the more you have a chance for interest rates to go up and down, right? And the farther away from your maturity date, the larger the potential price swings, when the rates move. So that's pretty much self-explanatory. As interest rates are changing, the longer you have these bonds, the more you can experience swings, up or down. So many investors don't realize there's an important difference between owning an individual bond. Okay, listen carefully. Owning an individual bond, a mutual fund or ETF. Okay. Many investors, they just don't realize there's differences in owning individual bonds and owning then a bond mutual fund or a, bond ETF. Okay. There are differences with all of those, and definitely understanding needs to be applied before you choose, either of those three. So an individual bond has a maturity date, which provides some certainty if you hold it until the end. So an individual bond, provides, some certainty because there's a specified maturity date. Okay. Bond funds, though, on the other hand, are constantly buying and selling bonds. Okay. They don't mature, and their share prices fluctuate daily based on the value of the bonds inside the portfolio. That means the value of your investment can rise or fall over time, and neither approach is automatically better. Okay. The right choice is going to depend on your goals, your need for income, your time horizon, and how you plan to use the money during retirement. Okay. Even when you're earning a higher interest rate, inflation is going to still matter. Right. And if prices are rising faster than your bond income, your purchasing power is shrinking. This is some self-explanatory. This is really common sense for you to understand these things. And so taxes, fees, and investment expenses can also reduce the amount of income you actually keep. And so the credit risk is another consideration when we're talking about bonds, and higher yielding corporate or municipal bonds often pay more because the issuer carries greater financial risk. The higher the risk, the higher the reward. Right. So higher income usually comes with additional trade-offs. So, if you're a conservative investor, you may, want to rethink getting into a higher yield, corporate bond, which is going to carry more risk. And finally, some bonds, they're also callable. Right. This means the issuer can pay them off early if interest rates fall. And if this happens, you may find yourself reinvesting your money at a lower interest rate than you, were previously earning. Okay. And so once again, bonds aren't 100%. It's not a guarantee that you couldn't lose money in a bond. Okay. Less risky, but not guaranteed, or, there is some risk. Okay. So rather than simply chasing higher, the highest yields available, you may want to consider matching your bond maturities, to when you actually need the money. If you're forced to sell before maturity because of an unexpected expense, rising interest rates could mean selling at a loss. Okay. And this is why we need, to potentially have a well-planned bond laddering strategy, right? This can, help to reduce the risk and also create some predictable income. So, all right, what's the bottom line here? Today's higher interest rates have certainly made bonds more attractive than they were just a few years ago, but higher yields don't eliminate the risk. And, this is the risk that comes with fixed income investing. Understanding how interest rates, inflation, credit quality, and your own time horizon, that's going to help you to understand, when you decide on the role of bonds in your portfolio, and your retirement planning strategies, you want to think through and understand how all those factors play a role. So if you're not sure, how today's interest rates environment affects your portfolio, or whether, your bond investments are aligned with your retirement income needs, we'd be happy to help you, sort through that as we are, continuing to schedule our complimentary consultations. Also, at our website, you can download a free retirement income for life survival kit, absolutely free. You can download that today, right at our website at retirement income, the number 4, life.com. And don't forget to give us a call if we can schedule that appointment by phone, 301-242-3950. Let's discuss a new way to think about this 40%, that we have been touching on related to bonds. And remember, we've been saying that this is unique to you. Okay. What's your retirement need? What tools do you need related to that 40% of your portfolio that specifically applies to you? Right. And, we've talked about what it means traditionally to have a 60-40 portfolio, and, that's the traditional way. Yes, he won a, Nobel Prize on that, or all types of accolades, related to that theory. But what I would be asking myself, instead of just, hey, just plug me into a 60-40, what I would be asking myself is, based on who I am, what percentage should go into bonds? Okay. Maybe the better question is, what does this portion of my portfolio actually need to accomplish? Okay. And this is where, the retirement planning becomes, much more personalized. Okay. And so we start with your goals. Your goals are going to be different than my goals. And one way to think about a modern retirement portfolio is to start with your spending timeline. Okay. You can, think about your spending timeline rather than, setting up a predetermined investment formula. Okay. How much money are you going to need to spend? Are you spending money earlier in your earlier years in retirement? What does that look like? And then you build out the investments. Okay. And, money you'll need over the next few years should generally remain liquid and easily accessible. Okay. Well, money that we earmark for later in retirement, should take on a different role. Okay. And that may be a longer term investment, right? But you're going to need money that's accessible, in your, checking, saving, money market, different places where it's accessible, immediately, especially in these first few years of your retirement, right? So every asset within your portfolio should have a specific job. Stocks may be there for the long-term growth. That's one job. But what's the job for your bonds, your cash, your CDs, right? What kind of liquidity do you need? And depending upon your goal and the specific, contract, okay, a fixed index annuity may play a role, may have a specific job. And this is going to help to provide principal protection, guaranteed lifetime income in a lot of cases for a portion of your retirement assets. And so the point isn't that everyone should replace bonds with annuities. Don't hear me say that. We're not saying, that one size fits all or these one specific product fits you or me, but is your portfolio built around your retirement needs rather than just relying on that formula that, it may not fit your situation? Fixed index annuities definitely fit a lot of people's planning, and we're going to dig in a little bit more on understanding that. But it definitely is something that can help a number of Americans. And we were doing a lot of that here in my office on an annual basis, weekly basis. So try dividing your retirement assets into three, just think about these three simple buckets. Okay. Money you need soon, money you're going to need later, and money that's designed to provide income for life. Okay. Let me say that again. Okay. Think about this in your retirement. This is money I'm going to need, soon, month to month. Money I'm going to need later, maybe 5-10 years down the road. Okay. And this money right here is designed, third bucket, to provide income for life. No matter what, when I turn this on, it operates like Social Security. It operates like my pension. I've created my own pension plan or my own income for life plan that I've designed from my assets that I've accumulated. Once you know the job each bucket needs to perform, choosing the right investment tool often becomes much clearer. Okay. And so the bottom line, no single investment can do everything well. The strongest retirement plans usually combine different tools. each one has their own role. Each one is designed to play a specific, role in your portfolio. And so this is why, as we, talking about, different things, but when we're talking about where you're heading, and as we take a closer look, at different options, for that 40%, okay, when you're not sure what you should do, with that portion, you want to make sure that you get some help, get a second opinion, let someone else work with you to show you, exactly what should be done as it relates to your goals, your asset protection, your growth potential, lifetime income, things of that nature. And, we're here to help with that. Okay, so let's dive into fixed index annuities and how you understand them. Okay, and we've talked about this before. You can see some future episodes on FIAs. But what we're doing here specifically today, we've been talking about building a retirement portfolio around purpose instead of percentages. Okay. And that leads to, another question that you should ask yourself, what role, okay, if any, should a fixed index annuity play in a retirement income plan? Okay. We're talking about income that you may need. Right. And so since fixed index annuities are often misunderstood, some people think they're, market investments, right? Others think, they're just too good to be true, right? And the reality for me is that they're somewhere in the middle. So let's break down what a fixed index annuity actually is, how it works, and why some retirees use them as one piece of a broader retirement income strategy. Okay, so a fixed index annuity, or what we call an FIA, is an insurance contract. Okay, it's not a stock market investment. Okay, while your interest may be linked to the performance of a market index like the S&P 500, right? Your market is not actually, it isn't actually invested in that index. Okay, instead, okay, so you see why you need diversification. We want money always invested. But in this case, a portion, it made sense to place in an insurance contract. Okay, linked to the index it was tied to. Okay, if you have an insurance contract, your principal is protected, but you're still going to get some gains, right? And so think about it this way, the insurance company is using the index as a part of a formula to calculate what we call interest credits. That means you typically don't receive dividends, and your returns may be limited by features such as participation rates, caps, or spreads. Okay, and so it's very important that you understand participation rates, caps, spreads, things of that nature, right? But the biggest trade-off is it's very straightforward, right? In exchange for the protection, the insurance from the, you're insured against any direct market losses. Okay. For that exchange, you give up some of the upside potential you might have if you were invested directly in the market. Okay. I hear this every single week. I do not want my $1 million portfolio subject to the market risk and the market volatility that could have my $1 million in, 1 week goes by and it's now 650,000. I don't want that much risk. This is where a portion of those investments, a portion of that $1 million potentially should be moved into an investment such as a fixed index annuity. All right. One feature that attracts many retirees is that principal protection. In general, if the market index has a negative year, listen carefully. If the market index has a negative year, your account just isn't credited. Okay. You don't get a market loss because of the decline. Okay. However, that doesn't necessarily mean you'll earn, your interest, you'll earn interest every year or not earn interest every year, right? Some years it just results in zero because the market was down 20 or the market was down 30. You just didn't lose that 20-30%. You protected your money. You didn't gain anything, but you protected your principal, right? And so it's important to understand that annuities aren't designed to be short-term investments. This is not something that you go into to try to move in and out, 1 year, 2 year, 3 years. Just think about it. Are you moving in and out of your pension? No, that's for the rest of your life. Are you moving in and out of your Social Security? No, we're trying to create vehicles, for the long term that complement your other long-term streams of income, because you might be in retirement 20, 30, 40 years. Okay. Hopefully you're getting the gist of this. All right. So withdrawals, or should I say, the withdrawals that you take, it's important to understand that the annuities, they're not designed for short term, and the withdrawals that you take beyond the contract limits can potentially, if you go over the amount that you're able to withdraw on a yearly basis, it could trigger a surrender charge. Okay, so you want to, think carefully about those withdrawals, and when you're going to take money out, how much you're going to take out. You want to know what the surrender charges are, and you want to know if, hey, am I going to have additional fees if I set up a optional income rider? Depending upon the contract, there are going to be different provisions, different benefits, different options, right? As well as there are going to be different participation rates, different caps, right? These things can change, over time. And so there's a lot of flexibilities, a lot of flexibility and a lot of benefits to why you would want to have specific riders and different things that are built into a fixed index annuity. They're trade-offs. And so it's very important that you find the vehicle that fits your specific planning. And the great thing about the industry today is that these have been built so that we can uniquely position a fixed index annuity for you that has the right packaging, for your long-term, retirement planning goals. So one reason also why many retirees consider fixed index annuities is it's not simply for growth, it's for income. Okay. And as traditional pensions have become increasingly rare, if you're not working for the federal government or, here locally, then you may not even have a pension. All you might have is that 401k. How about understanding how we can turn that 401k, a portion of it, into your own pension? So now, if you didn't get the pension from the job, you got Social Security, and you now have created a pension. The fixed index annuity is a good vehicle that we have been using to turn that savings into lifetime retirement income. And so many fixed index annuities offer optional lifetime income features, and they can provide guaranteed payments for as long as you live, just depending upon the terms of the contract. The amount of income is going to depend upon a number of different factors: how old you are when you begin taking those payments, the amount that you contribute, and then also specific rider or payout options that you have to choose from. For many retirees, the goal isn't to guarantee every dollar that you spend, right? Instead, it's to make sure all your monthly expenses are covered. Okay. If you have fixed income coming in, you want to make sure that those fixed bills are taken care of: your housing, your groceries, healthcare, insurance, your utilities. You want to make sure your basic living expenses, they're covered by guaranteed income products or guaranteed income, vehicles. Why? Because you're retired now. You're not going out to work, 40 hours a week. And so this is going to allow you to rest easy, have peace of mind, building a portfolio to remain invested for the long term, with that discretionary spending piece also, taken into consideration. Okay, let me give you some statistics here. 30.7 billion fixed index annuity sales were done during the second quarter of 2026. Okay, this particular investment product fits a lot of people's portfolios, right? This is an increase in FIA sales that was compared to the first quarter of 2026. So first quarter of 2026, billions of dollars of fixed index annuities were put in place, and now 30.7 for the second quarter, right? So This is something that fits a lot of people's portfolio. If that amount of money is going into them, we want to take notice. We want to learn from them. And so only 99%, the percentage of private sector workers participating in a traditional pension plan today, there's only 9%. And so helping explain, why those billions of dollars are going into fixed index annuities, creating their own pensions, right, is because we have a lower amount of Americans that actually are getting a pension from their job. Okay. This is going to explain why you're going to continue to see those numbers go up for fixed index annuities, as the years go by, because people want to create guaranteed income. Social Security, people are even being scared there, being uneducated there, but that's only supposed to be a fourth of your retirement income. So before you purchase these, right, understand the risk, ask the details, look at the contract in writing, right? Understand the terms, understand the rates, the surrender schedules, the rider costs, how is the interest calculated? The more you understand before you sign these, sign up for these, the more confident you'll feel, whether this contract fits your retirement plan. So what's the bottom line on FIAs, right? It's not designed to replace every investment. Okay. But it may be designed to replace some, right? It's not right for everybody, but it might be right for you. Okay. Understanding your objectives and how they apply, to your values as you're retiring, principal protection may be very, very important to you. Okay. You don't want any direct market losses. You want guaranteed income. You want to make sure this is going to last for the next 20, 30 years. And so, like every tool in retirement planning, the question isn't whether an annuity is good or bad. The question is, does it fit my specific goals and objectives? And I cannot give this fixed index annuity a job that you're asking it to do. We want to put these investments to work, and a fixed index annuity might just be something for you. So if you're wondering whether, an FIA could play a role in your retirement plan income, retirement income plan, and, you may already own one, you want it reviewed, or, you're not sure how these work. You like what you're hearing from me today, we'd be happy to review what you currently have or what you would like to put in place. We can give you a number of different tips on if this fits or if it doesn't. Just go to our website, retirementincome4life.com. Call our office, 301-242-3950. And you'll be able to schedule that consultation, and we can, look into all your fixed index annuity needs. All right. As we wrap up today, every retiree, as you look into your retirement bag, right, those tools are going to have trade-offs. Okay. We're trying to give you the understanding of the 60-40 trade-offs, right? And digging into that, why bonds, why annuities, and so throughout today's program, we've talked about the traditional 60-40 portfolio, why diversification still matters, and how fixed index annuities can fit into some retirement income plans. So here's what I want you to take away from today. There is no perfect investment or retirement product. Okay. Every strategy comes with advantages. Okay. And every strategy comes with trade-offs. The key is making sure you understand both before you make a decision. Okay. Understand what you're giving up. Understand what you're adding. Okay. Whether you're investing in stocks, bonds, CDs, annuities, every option asks you to make compromises. Okay. With an annuity, for example, you may gain principal protection or guaranteed lifetime income, but you also give up some liquidity and in many cases, some growth potential. Okay. Emergency savings and money that you need for the future generally shouldn't be locked away into long-term contracts. Someone advising you to put all your money in an annuity, I would say that probably is a bad suggestion. Okay. How are you going to be able to handle the short and intermediate term unexpected things that happen if all your money is locked away in a long-term investment, although you need long-term investments? Okay. And so the emergency savings, money you need for the future, yes, there's certain limits and withdrawals with annuities and different surrender periods. But you don't want to be in a position to where you have to take more money out than necessary and then be charged on different fees. Also, taxes. Okay, you've got to take into consideration that although an annuity's growth is tax deferred, once it distributes, you're going to then, in a lot of cases, have to pay taxes on that money. And so are you moving yourself into a higher tax bracket because you're taking out higher withdrawals? It's going to depend upon if the money's qualified, meaning it was in a 401k or IRA, or if it was non-qualified. That means it's going to be, capital gains on that, or, some type of capital gain. And so taxes are also a factor in these decisions on which you choose and which you don't choose, right? And it's very important that you know the tools in your bag, how they are going to affect you. What tools do you need to add to the bag, right? And so, for instance, if you already own an annuity, don't assume that replacing it is automatically the right move. It may be, but not automatically. And so a newer contract may offer features that are better. You might fit your goals for the future, but they could also restart a surrender period, right? And cause you to lose valuable benefits that you've already earned. Okay, so you want to make sure you analyze that. And, from those annuities that you currently have, we do replace annuities the right way a lot of times. But then a lot of times, we review them and say, no, you need to stay right where you are. Okay. And so also, we haven't mentioned a lot, but today let's mention, as we close, let's talk about variable annuities. Okay. Variable annuities offer market participation. They're optional guarantees sometimes, packaged in. They can also include multiple layers of fees, though. Okay, so you got to look to make sure, you're not being overcharged and not knowing it, right? Including the insurance charges, their investment expenses with variable annuities, also potentially rider costs, right? Understanding the total cost is much more important than focusing on just one single fee. Okay, so before making any changes to your variable annuities or your fixed index annuities, compare the old contract to the new ones, do a side-by-side analysis, look at the guarantees, the fees, any surrender schedules, income benefits, and, how you can access your money. You want to know how that money is growing and what you're giving up, what you're keeping, what is the trade-off. Okay, so before making any retirement planning decision, ask yourself this one simple question. You're coming up on retirement now, or you're coming up on retirement in 1 year. You're coming up on retirement very soon. Okay. The investments or products or services or my retirement income plan. Okay. What problem is it solving? Ask yourself that one simple question. What problem is what I'm putting this money in, or where my money currently is? What problem is it solving? Right. And if you understand that it needs to be purposeful, right? This investment has a purpose, right? And then the trade-offs that come with it, if they fit, your unique situation as well, you're going to be much more confident that it belongs in your overall retirement plan. Okay. Let me say that again real quick. What problem is it solving? What problem is where your money is? Where is this? What problems is it solving? Okay. What is the purpose for this? Okay. Have I done the assessment necessary to make sure that I can go into retirement confidently, well diversified with purposeful products and services, investments, and then making those decisions, on a yearly basis to potentially update, the way that you felt, some years before, or even leading up to now needing a cost of living or inflation adjustment into your overall income stream. Okay. And so the 60-40, traditional, strategy could work for you, right? We've discussed, updating that investment strategy, right? Using other tools that can replace bonds in a lot of cases, right? Understanding the volatility in bonds and the different types of bonds, but the use of a fixed index annuity, we know one size doesn't fit all, But that 40% or whatever percentages that we are using doesn't FIA fit what you're trying to accomplish. So the best retirement plans aren't built around products. Okay, hopefully you're hearing me say that today. The best retirement plans that we build on a weekly basis and help our clients each and every year, they're built around you, the person, not the product. Okay. And so you want to combine these tools together, the right amounts in the right places. The right amounts are in the right places for the right reasons. This is based on your goals, your income needs, your timeline, and your comfort with risk. Okay. So if it's been a while since you've reviewed your portfolio, you want a second opinion as you're preparing for retirement, you could be wondering whether your current investments or your retirement income strategy is still working together. We're here to help you on a daily basis right here in our offices. Schedule a complimentary consultation or retirement income review today. We can do a Zoom meeting if you're not in the DMV area. Just go to our website, retirementincomeforlife.com. We look forward to helping you with all of your retirement planning needs.